Earlier this year, the IRS released their final interpretation of the new 10-year rule for inherited IRAs. But are there any exceptions to the new 10-year rule? There are. I'll explain that more coming up. My name's Mike Brown, the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. After 4 years, the IRS earlier this year officially came out with their final interpretation of the new 10-year rule. Now, this was embedded in the Secure Act 1.0. We were already on to Secure Act 2.0, by the way. But Secure Act 1.0 was passed late 2019 and took effect in 2020. And it did away with the stretch IRA and introduced instead the new 10-year rule. So if you had inherited an IRA from anyone that had passed away before 1/1 of 2020, then you are grandfathered in under the old rules. And those old rules, the stretch IRA, means that you can take out from that inherited IRA as much as you want. It's going to be taxable to you, but you can take out as much as you want. If you need it, you can take it all out if you need to. But if instead you don't need it and you want that asset to continue to grow for your financial future, the IRS says, okay, that's fine, but you have to at least take out a minimum amount, a required minimum amount out each and every year based on your own life expectancy. And that's a way for you to take out this minimal amount, but let the asset grow and stay a part of your financial life long into the future. Well, Secure Act 1.0 grandfathered those folks if you'd already had that in existence, but it introduced this new 10-year rule for anyone that passed away on or after 1/1 of 2020, that instead of being able to stretch this IRA out or this pre-tax account out over your entire lifetime, you had to have the account emptied within 10 years. So someone passed away, if you inherited an account, an IRA, let's say from a parent, and they passed in 2022, you would have to withdraw the entire account, have that inherited IRA completely emptied by 12/31 of 2032. That's the 10-year rule. And earlier this year, the IRS clarified that if the person you inherited the dollars from was already had already passed their required beginning date, meaning they had been subject to required minimum distributions, then you are forced to take a required minimum distribution every single year as well, and still have the account emptied within 10 years. Well, are there any exceptions to that? Yes. Under this category, this very confusing title called eligible designated beneficiaries, there's 5 exceptions to that 10-year rule. Take a look. It's surviving spouse, minor children who are under the age of 18, disabled individuals and chronically ill individuals, as well as any other individual who's not more than 10 years younger than the deceased account owner. So let's weave that into a scenario, a question that we received recently, and that is, I'm 67 years old and I inherited an IRA from my brother who was 69 and when he passed away in 2002. I'm told that I do not have to withdraw the account under the new 10-year rules. Is that correct? Well, going back to that list of 5 eligible designated beneficiaries, yes, that is actually true. You would qualify, this scenario qualifies under one of those exceptions, this sort of catch-all exception that says any individual, friends or siblings who are identified, who are listed as beneficiaries of a retirement account that are less than 10 years younger than the account owner. And in this scenario, the account owner was 69, you're 67, you're within that 10-year window, and therefore you have more flexibility. That's what this eligible designated beneficiary, that's what it means. Eligible for what? Well, eligible for more flexibility beyond just this rigid normal 10-year rules. And each of these is a little bit different, okay, but for this category, for this scenario, this 10-year age difference, then yeah, the IRS basically looks and says, well, if you're within 10 years, if you're not more than 10 years younger than that individual, you know what? We're just going to treat it as if since you guys were similar enough in age, we're just going to treat it as if this was your original account. And therefore, in that scenario, you do not need to abide by the new 10-year rule. Instead, you can revert back to the stretch IRA and apply that thinking. And that is, if you need the money, you can withdraw as much as you want. So in that scenario, if you inherited $100,000 and you need $50,000, take out $50,000. But if you don't need the money, or if you want that asset to continue to grow for you out there in the future, then your only requirement, your obligation, is to at least withdraw a minimum amount out each and every year over your life expectancy, not the original account owners, your life expectancy, just like the original stretch IRA rules worked. So you can take out more than that if you need to, but each year you've got to take out at least this minimal required amount. So yes, there are exceptions to this new 10-year rule, and this such scenario is absolutely one of them. But it underscores the point that we've made as we've shared other content, other sort of facts about how this new 10-year rule works, and that is, anytime you're inheriting retirement accounts from someone else, that's a financial planning issue that you should be working with your certified financial planner on. Number one, so that you know the rules. Number two, so you can strategize from a tax standpoint what makes the most sense. Should you draw more out now? So take this example for this individual. If he's 67, then and he's still working, maybe you should draw some of that out and start funding your Roth 401k or Roth IRA, so that those dollars, you transition them from growing tax deferred and eventually taxable, transition them into a pre-tax account. So anytime you're inheriting a retirement account from someone else, that's a financial planning issue. Financial planning decisions need to be made. You need to look at all 6 areas of your financial life to make wise decisions with those dollars. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.